or something, but you can only ask questions that are based on today's Learning Unit 3. So if you have any other questions regarding other units that have been covered, you can post them on the relevant discussion forum. So you're also encouraged that you do some revision assignment questions, which is very important for you to do so. Let me start with today's session. So today we are covering the financial market, which is your Learning Unit 3. So once you have worked through this learning unit, you should be able to explain in words by means of chain of events and diagrams the demand for money and how income and the interest rate influence the demand for money. Also explain in words how the interest rate is determined, explain in words endogenously determined money, and lastly should be able to briefly describe the conduct of money policy in South Africa. So now let's look at the demand for money, which is 3.1 on your study guide and 4.1 of your prescribed textbook. So the first thing you need to understand is that the demand for money refers to the need by economic participants to keep money and have it available. So this is referred to as their liquidity preference. So remember from Economics 1, the economic participants, we should be talking more about your households and firms. So it is also important to distinguish between the concepts money, income, and wealth. When we talk about money, so money is a medium of exchange used for transactions, which facilitates the economic activities. So in this model, money consists of coins and notes issued by the South African Reserve Bank, as well as the checkable deposits held at banks. When you talk about income, so this is money earned or received over a specific time period, which indicates a flow of funds. And lastly, wealth is a total value of assets owned, representing an accumulated financial value. Also, we should take note that money has its functions. It can be used as a medium of exchange, unit of account, store of value, and a standard for deferred payment. So when we talk about money as function of medium of exchange, it means that goods and services exchanged for money according to their allocated value. Then money as a unit of account is refers to a common measure to indicate the value that everyone can interpret. For instance, in South Africa, the unit that we can understand is rands. So South Africa uses rands, and in the USA, they use dollars. So now we look at money as a store of value. This means that money retains value over time, which allows people to save and transfer the purchasing power from the present to the future. So money can be stored now and used later. And lastly, money's function as a standard of deferred payment means that it's used to make arrangements for future payments. So like your loans or contracts where the value of the transaction is expressed in monetary unit and it is expected to be settled later. So essentially this means that it allows us to buy goods or services today and pay them later, which is important for credit transactions and long-term contracts. So an essential part of a financial market model is the portfolio decisions of financial market participants. So a portfolio decision refers to the choice by financial market participants as how much of various assets they wish to hold. So there are, in this model, financial market, there's only two choices for our financial participants, which is either a choice between money or bonds. There there are many kinds of assets in which financial wealth can be held. It could be your shares and bonds, which could be your treasury bills, the real estate, like your houses, paintings, the residential property and gold coins, the foreign exchange, as well as money. So a decision to hold more of one asset, for instance, the treasury bills, your bonds, or less of another asset is called a portfolio decision. So a portfolio decision also includes the decision to hold money or less of the money. So are you guys following?
Yes.
Okay.
Yes, I'm following.
Yes.
Okay. So now let's move to the money demand and how it is derived. So demand for money is determined by active and passive demand for money. So it is important that we make a distinction between the demand for active balances and the demand for passive balances. So the demand for active balances is influenced by people's need to do transactions, while the demand for passive balances is related to the need to keep wealth in the form of money. So in this sense, we say that money is viewed as a financial asset. So active balances, this is money held for transactions and daily expenses such as buying goods and services, paying bills, and other immediate needs. And your passive balances, these are funds held for future use, such as in savings or investments, but not immediately needed for transaction. So you need to be able to make the distinction between these two concepts. So now let's discuss the demand for active balances. So the demand for active balances is influenced by people's need to do transactions. So the more transactions there are, it means that the higher demand of money for money. So the demand for money or transaction then arises from the fact that money is used as a medium of exchange. So we need to understand then what affects these numbers or this number of transactions. So the number of transactions, which is the need for active balances, is determined by the level of output and income in the economy. So the higher the level of output and income in the economy, the more transactions there will be. So as the level of output increases, it means that the income of households will also increase, and they will want to do more transactions. They will therefore need more active balances, and their demand for money will rise. So as well as producers, when they produce more of an output, they will need more money to finance the transactions as well. So this can also be presented in chain of events, like we explain it in words. We can also explain it by chain of events. Say that the demand of active balances, as the level of output increases, which is why as it increases, the income of households also increases, which increases the active transactions, which in turn increases the demand for money. So that is the demand for active balances. Does anyone have a question? Okay. So let's look at the demand for passive balances, which is also referred to as the speculative demand for money. And it is related to the need by the financial participants to keep wealth in the form of money. So in this sense, money is viewed as a financial asset. Sometimes the financial participants wish to hold money, not because of doing active transactions, but because of the need to keep their wealth in the most liquid asset there is, which is they prefer to keep money, their wealth in terms of money. So hence, the speculative demand for money stems from the store of value as a function of money. So in our model, the financial market participants have the choice between keeping money and bonds. Your bonds being in this case your treasury bills. So the treasury bills are short-term financial market instruments that are issued by the government when it borrows from the public to finance its spending. So this instrument is fully secured by the government and guaranteed. So in South Africa, the South African Reserve Bank acts as an issuing agent of those treasury bills. So if the financial market participants expect the price of treasury bills to fall, in the future, they will be motivated to hold money instead of treasury bills. If, on the other hand, they expect the price to increase in the future, they will prefer to hold treasury bills. So this is the reason, as we need to understand as to why do the people or the financial participants prefer to hold bonds instead of money. So the reason is that the opportunity cost of holding money is the interest rate that is given up, because money doesn't yield any interest. You just keep it and it doesn't give you any interest. While when you keep bonds, it has a form of a part of a financial gain. So that would be the reason why hold bonds instead of money. So the higher the interest, the higher the opportunity cost of holding money, since money earns no interest. So based on this opportunity cost of holding money, we can expect that the cost of holding money, when it goes up, the financial market participants will be less motivated to hold money. They will opt for bonds. So therefore, there is a negative relationship between the interest rate and the demand for money. Because when interest rate goes up, the demand for money goes down. So we can also represent that in terms of a chain of events. We have explained it by words. We can now explain it by chain of events. So an increase in the interest rate, will mean that the demand for the passive demand for money will go down, and the demand for money will go down. And also inversely, when the interest rate goes down, the passive demand for money will go up, and the demand for money will go down. So that is your demand for passive balances. Are you guys still fine? Okay, so now that we've understand the determinants of money, we can represent it graphically. We have explained it by words and chain of events. Now let's explain it graphically. So we have two graphs. So at this point, we have determined or established that the demand for money is a positive function of the level of output and income, and a negative function of interest rate. So when representing the demand for money graphically, we have these two graphs. We indicate the interest rate on the vertical axis. We have our interest rate on the vertical axis and the quantity of money on the horizontal axis. So the demand for money, which is MD on the graph on the left, which represents the change in the interest rate. Sorry. So basically, in terms of the chain of events, we have established that an increase in the interest rate will decrease the passive demand for money, and also decreasing the demand for money. We can represent this in this graph. I'm trying to have some pointers. I'm trying to get some arrows to make a pointer here. So on this graph, I'll try to explain because I'm trying to make some arrows to show the increase. So an increase from I1 to I2 will be represented, which is from the interest rate, will be represented by the upward movement from, let's say this is A to B. So the upward movement on the empty curve is a result of the increase in the interest rate. Therefore, the quantity of money will also decrease from M1 to M2. So what you need to take note of is that any change in the interest rate will be shown by the movement along the empty curve. So the change in interest rate is shown by the movement along the empty curve. Now, so let's move to the other graph, which shows the change in the level of output and income. So the position of the money demand curve is determined by the positive relationship between the level of output and income and the demand for money. So at the output and income of Y1, the demand curve is MD1, as indicated in this graph. So as the level of output and income increases from Y1 to Y2, the demand for active balances also increase as financial participants wish to do more transactions. So at each of these interest rates. So therefore, at each of the interest rate, the demand for money is also higher. It will cause a rightward shift from MD1 to MD2. And this rightward shift of the demand curve takes place. So in turn, our quantity of money will also increase. So also what you need to take note of when there's a change in the level of output and income, it causes a shift of MD1 curve to MD2 curve because our households will have more transactions to make, so that shifts our MD1 to MD2. So once more, if there's a change in the interest rate, it causes a movement along the curve. Then if there's a change in the level of output and income, it causes a shift in the empty curve. So that's your demand for money. We have explained it by words, explained it by chain of events, and lastly, we have explained it graphically. So you should be able to do this on your own. There are also some questions that you can go through on your study guide so that you understand, and you need to read every detail on your study guide so that it also makes sense to you. So is everyone following? Is everyone okay with this?
All good from my side.
Sorry?
All good from my side, thank you.
Okay, thank you. So let's just go through your questions to see that you guys are following. So true or false question: financial wealth can be held in different assets such as shares, bonds, houses, residential property, and foreign exchange. Is this statement true or false? You can just open your mic and answer. Anyone?
I'd say
Okay.
true.
It's true, ma'am.
Okay, that is correct. Let's move to the next question. So money does not form part of financial assets. Is the statement true or false?
It is true.
No, that is incorrect. So money does form part of the financial assets. So having to say that the statement is false. Money does form part of your financial assets. Let's move to question 3. So the demand for active balances is related to people's decisions and the need to keep wealth in the form of money. Is the statement true or false?
It's false.
Correct. The demand for active balances means that transactions, it's for transactions that can be made immediately, not to keep wealth in the form of money. So this statement is indeed false. So now let's move to 3.2, which is the quantity of money. It's 3.2 on your study guide and 4.2 in the prescribed textbook. So the financial market model assumes that the quantity of money is endogenously determined, not exogenously determined. So we need to understand what that means, what endogenously determined money means, which is often, also known as demand determined money. So this implies that money is determined within the model or by the model. So in this financial market model, it is assumed that the quantity of money is determined by the demand for money. In other words, as the demand for money, as the money demand changes, so does the quantity of money. So an increase in the money demand leads to an increase in the quantity of money, and also, inversely so, a decrease in the demand for money leads to a decrease in the quantity of money. So now let's look at the impact of the level of output and income on the demand for money, as well as on the quantity of money, since we are talking about quantity of money. So let us first consider the impact of the change in the level of output and income on demand for money and the quantity of money. So we should be able to explain this by words, chain of events, as well as the diagram. So as the level of income and output increases, the demand for transaction balances increases, and in turn, this causes an increase in the quantity of money through credit extensions by banks. So when your level of output increases, how does it affect your quantity of money? So the demand for transaction also increases, and that in turn increases the quantity of money. So by chain of events, we say that an increase in the level of output and income leads to increase in the money demand, as well as an increase in the quantity of money. So that is the impact of the level of output and income on the demand for money and the quantity of money. So now we also look at the impact of interest rates on the demand for money and the quantity for money. So a change in the interest rate impacts on the amount of money demanded, since it changes the amount of money and bonds people wish to hold. So as the interest rate decreases, the amount of money people wish to hold will also increase, since the return on bond is lower. So people will rather keep money. So as people wish to hold more money, the amount of money demanded increases, so does the quantity of money. So that is the impact of the interest rate on the demand for money and quantity of money. So now that we explained that by words, we can also explain it, represent it by chain of events, which is a decrease in interest rates related to a decrease in demand, an increase in demand for money, as well as an increase in the quantity of money. So the last part is the interest rate and the quantity for money. So in this model, the central bank is unable to directly influence the quantity of money, since the quantity of money is endogenously determined by the demand for money. However, the central bank can indirectly influence the quantity of money by influencing the interest rate, which in turn affects the cost of credit and loans and the demand for money. So a lower interest rate decreases the cost of credit. Credit becomes cheap. As more credit is extended to households and firms, your economic participants, the financial participants, the money demand and the quantity of money will then increase. So then the central bank targets the interest rate and adjusts the quantity of money, but the change in the interest rate also adjusts the demand for money. So according to this interpretation, there is no independent money supply curve, since the quantity of money depends on the money demand and the interest rate, which is the cost of credit. So this is called the demand determined money. Hence, we say that money is endogenously determined. So this interpretation explains exactly that. So I hope you guys are following. But let's see, let's look at this question again, true or false question. The impact of an increase in the interest rate on demand for money can be represented by an upward movement along the money demand. Is this statement true or false?
It's true.
That is true. So let's look at this graph. The impact of an increase from I1 to I2 will be represented by the movement along the empty curve, which is point A to point B. It's upward movement. So if it was a decrease, it's going to be a downward movement. So it's correct. The demand for money depends on the level of output and income. Is that statement true or false?
It's false.
Correct. So the demand for money depends on the level of output and income and the interest rates, not the money supply. So you are correct. So now let's move on the last section, which is 3.3, the monetary policy in the financial market. Subsection 4.3 on your prescribed textbook. So for this subsection, we have to describe monetary policy, explain how the central bank influences the interest rate in the financial market, and lastly, we have to explain the conduct of monetary policy in South Africa. So monetary policy basically is defined as measures taken by the monetary authorities to influence the quantity of money or the rate of interest with a view of achieving a stable prices, full employment, and economic growth. So one would ask, but how does the central bank influence the interest rate? So in South Africa, monetary policy is formulated and implemented by the South African Reserve Bank and the accommodation policy, which is also referred to as the refinancing of liquidity requirements. And it is an important instrument they have at their disposal to influence the interest rate. So it is through the accommodation policy that the Reserve Bank, South African Reserve Bank, provides financing to banks that require liquidity. So in South Africa, the South African Reserve Bank controls the interest rate by using the open market operations to adjust the money market deficit to influence the market interest rate. So the interest rate at which this accommodation policy or the refinancing takes place is referred to as the repurchase rate, which is known as the repo rate. So the changes in the repo rate affect all interest rates in the economy, and thereby the cost of credit, demand for, and quantity of money. So remember, we recently had a cut from the repo rate in South Africa, which is now at 7%, which was cut by 0.25. So we'll look at the impact that has in our economy. So now let's look at the conduct. Is there a question? Okay, so let's look at the conduct of the monetary policy in South Africa. So money consists of both currency and demand deposit. Let's just look at a background, a little background of how money is created. So money is created by banks when a loan is approved and a demand deposit is created against that loan. So if for instance, you wish to buy a second-hand car for 50,000 and you do not have the cash available, you can approach a bank for that loan. So if the bank approves the loan, it then creates a demand deposit for you, which is money that will be available for you to use to pay the supplier for the second-hand car. So when a bank creates this demand deposit for you, the quantity of money increases since the quantity of money consists of cash and plus your demand deposits. So banks can just freely lend out money without limit. So the minimum reserve requirement and profitability considerations constrains the bank from systems from ability to create money. So these are some of the details that you need to study. They are there on your learner guide. So now the quantity of money is now a function of creation of demand deposits, which is the demand for money and is no longer exogenously determined by the central bank. So for the central bank to influence the quantity of money, it needs to influence the creation of demand deposits. So in South Africa, the Reserve Bank does this mainly through the repo rate, which is the repurchase rate. Now, the repo rate is the rate at which the private banks borrow money from the South African Reserve Bank. And the repo rate is the policy rate interest in South Africa. So all other interest rates in the market, such as your prime lending, follow the changes in the repo rate. So you notice that after there was a cut in the repo rate, a lot of interest in the bank have decreased, such as people who had loans or paying bonds. There were changes there because of the repo rate. So every other interest in the market follows the repo rate. So the central bank then ensures that the banks continue to borrow money in the central bank at the repo rate by creating that persistent liquidity deficit in the money market using the open market transactions. So an increase in the repo rate. So an increase in the repo rate increases the interest on loans. So let's say if it had increased in South Africa by that 0.25 instead of decreasing, that would lead to an increase on loans. And as the interest rate on loans increases, the demand for money would decrease. and the number of loans would decline. And consequently, so fewer demand deposits as a result will be created and the quantity of money will decrease. So to correct this, or to manage the economy, the SARB would either do two things, which is implement an expansionary monetary policy or implement a contractionary monetary policy. So if SARB wishes to follow an expansionary monetary policy, which is what has happened when the repo rate decreased, if SARB wishes to follow that expansionary policy to stimulate the economy, they will decrease the repo rate. So this decrease in the repo rate decreases the interest rates and the cost of credit in the economy, and consequently the demand and quantity for money will increase. So this explanation can also be represented by chain of events. So we say that a monetary expansion leads to a decrease in the interest rates, which in turn increases the demand for money, as well as leads to the increase in the quantity of money. So if, on the other hand, the South African Reserve Bank wishes to follow a contractionary monetary policy, which is tighten the economy, they will increase the repo rate. So this increase in the repo rate increases the interest rates and the cost of credit in the economy, and consequently demand for and quantity for money will also decrease. So a contractionary monetary policy means that the economy will tighten. So as a result of that, interest rate increase, then it affects the demand for money, which also decreases, as well as the quantity of money. So we can explain that also by chain of events, say that a monetary contraction will lead to an increase in the interest rate, which leads to a decrease in the demand for money, and a decrease which leads to a decrease in the quantity of money. So interest rates increases, there won't be much money in circulation. People won't be able to, will make less transactions, so that increases the money in circulation in the economy. So as a result, the demand for money decreases, and the quantity of money, which is money in circulation, also decreases. Is everyone still following? Is everything clear? Do you have any question based on this? Okay, so if you guys are fine, I am also okay. So let's look at, we've explained the expansionary and monetary policy in terms of words, chain of events. Now let's show that in the graph. So it's very important for you guys to take note of this and make sure that you understand. So when you're answering questions like this with graphs, at least try to label your graphs correctly. Those are marks that you should get before even trying to explain. So by chain of events, we established that an expansionary monetary policy leads to a decrease in interest rates, which increases the demand for money and increases the quantity of money. So the graph on the left, let's try to explain that in the graph. So expansionary monetary policy leads to a decrease in interest rate from I1 to I2, that decrease. So that decrease in the interest rate will be shown by the downward movement along the empty curve, which in turn decreases the quantity, it increases the quantity of money from M1 to M2. So that is the result of the decrease in the interest rate, which is your expansionary monetary policy. Then moving to the contractionary monetary policy, which refers to an increase in the interest rates by the central bank. So by chain of events, we established that monetary contraction, which is tightening the economy, it leads to an increase in the interest rates. So that would be from I1 to I2, which will be shown by the upward movement along the empty curve, which leads to a decrease in the quantity of money from M1 to M2. So that is the contractionary monetary policy explained in the graphs. So lastly, we've explained it by words that you need to understand that by chain of events, what you have on your chain events, it also helps you to plot your graph correctly. So whenever you're starting anything that has to do with your graphs, make sure that you have a pen and a paper just to make sure that you are doing the correct thing. So that is your expansionary and monetary policy. So does anyone have a question? Do you seek any clarities? Okay. So this is the last part of the question. So I need you guys to engage. This is a true or false question. So the first question is, monetary policy can be defined as measures taken by the monetary authorities to influence taxes and the rate of interest rate with a view of achieving stable prices for employment and economic growth. Is the statement true or false?
I think it's false.
Why do you say that?
I said,
Sorry? Okay, you are
I'll
correct.
say it's
Sorry?
okay.
Yes,
I think
please go ahead.
But I'm saying false because it speaks to full employment, economic growth, stable prices. That's more like a fiscal policy than a monetary policy.
Okay, you are correct. The statement is false because when you talk of taxes, that does not form part of the monetary policy. Taxes and government spending, that is fiscal policy. So the statement is false. So let's go to the next question. The South African Reserve Bank uses the accommodation policy, and it is true, this accommodation policy, that the South African Reserve Bank provides financing to banks that require liquidity. Is the statement true or false? We just covered this on the most recent.
I would say it's false because it uses repo rate.
So it uses both the repo rate and the accommodation policy. So the statement is true. So these are some of the details that you need to go through on your study guide that maybe would not be easy to point out. So just when you're studying, just go through everything on your study guide. So the statement is correct. So next question is the interest rate at which this accommodation policy or refinancing takes place is referred to the repo rate in to as the repo rate in South Africa.
I
It is
think
true.
that is true.
That is correct. So the aim of the contractionary monetary policy is to decrease the level of economic activity Therefore, the South African Reserve Bank will increase the repo rate. Is this true or false?
That's true.
It is true.
That is correct. Lastly, the chain of events for monetary expansion is that a decrease in the interest rate leads to an increase in the quantity of money, which leads to an increase in the demand for money. Is that true or false?
It's false.
That's true.
I think it's true.
True.
I'm saying it's false because I think we should increase the demand for money before we increase the quantity of money. So it's the other way around.
That is correct. So the statement is false. It's actually the other way around. So a monetary expansion leads to a decrease in interest rate, which in turn increases the demand for money, not the quantity of money, as the statement says. So it increases the demand for money, which in turn increases the quantity of money. So that's a little change that you need to take note of this, and not just answer, because there would be a little detail that you haven't seen. So take note of the MD, the positioning of the MD and the M. So sometimes it's going to be confusing, but you need to take note of these and not make the mistake. So a monetary expansion, it's a decrease in interest rates, which increases the demand for money, which in turn increases the quantity of money. So this statement is false. So that concludes our class for today. Does anyone have a question? Do you seek any
Yes.
clarities?
Yes, yes, ma'am.
Yes.
Will the PowerPoint be made available?
Yes, the slides will be available and the recording will be available.
Okay, thank you.
Okay. Any other question? Mrs. Ace, are there any questions in the chat? I cannot see from my screen.
Okay, good day. No, I can't see any questions. I stopped the recording and I think they are happy.